Welcome to Talk Tickers, your essential deep dive into the financial stories that really matter. Today, we're cracking open the Q3 2025 earnings call for Brookfield Asset Management. Bam. And if you just glance at the numbers, well, this quarter sends maybe a bit of a mixed signal. But if you look at the actual strategic moves, this was really a period of record-breaking capital formation and some pretty substantial positioning in global credit, and maybe most importantly, that massive infrastructure build out we're seeing driven by AI.
Exactly. And for an asset manager of this sheer scale, the immediate profit and loss statement, sometimes that's actually the least interesting part.
Right.
We're aiming to go beyond the headlines here to really help you understand the power of their operational engine. And, management's pretty aggressive outlook, especially when you look at their 2026 fundraising pipeline.
Okay.
The real question we're tackling for you is, well, why was the market's reaction so muted? Especially given the sheer volume of capital that moved this quarter.
Okay, let's start right there with that immediate financial snapshot. Distributable earnings per share, D-share, that came in at $0.41.
Right.
Which was actually a slight beat, It edged out the street's consensus, which was hovering around, $0.39 to 44 cents. And GAAP diluted EPS looks solid, too, at $0.44. But, like you hinted, the caution really came on the top line. Revenue landed somewhere between $1.25 billion and $1.27 billion.
Yeah.
And that fell short of the $1.34 billion consensus estimate.
And that revenue that's likely the main reason the stock actually closed slightly down, despite those decent D-share figures.
Okay. But
just focusing on that revenue difference, it kind of misses the operational story happening underneath. BAM actually set records this quarter.
Records how?
Well, they raised $30 billion. They specifically cited that as their highest organic pace ever.
Wow.
They deployed $23 billion. And crucially, they monetized $15 billion. That kind of rapid capital recycling, raising, deploying, selling, raising again, that's the real heartbeat of their business model.
Okay, hold on a second, though. You keep emphasizing these operational records, this flywheel theory, right? But the stock closed slightly down because revenue missed consensus. Doesn't that suggest the market cares more about the immediate P&L right now than maybe your longer-term capital deployment thesis?
Well, it suggests the market might be focused on, let's say, the wrong quarter or maybe just one data point. The quality of earnings here is really paramount for a company like this.
Okay.
Fee-related earnings, or FRE, that's the steady income stream, right? That grew 17% year over year to $754 million.
17%, okay.
And that maintained a solid FRE margin, approximately 58%. Overall, distributable earnings grew 7% to $661 million. So, when the steady engine room is growing double digits, you tend to look past a slight revenue blip that might be caused by temporary factors.
All right, let's look closer at the foundation of that engine then. Fee-bearing capital, FBC. Where does that stand?
FBC reached $581 billion. That's an 8% increase year over year.
Okay, $581 billion.
And management sounds highly confident. They really believe they can sustain a double-digit growth trajectory in FBC going forward. They back that up by pointing to the $106 billion they've raised over just the past 12 months.
$106 billion.
Yeah, and that's mostly uncalled capital. It's money that's committed, sitting there waiting to generate fees as soon as it gets deployed into deals.
Got it. Now, I'm curious about the margin, that 58% FRE margin you mentioned. That sounds like a blended number. Given the scale of the recent acquisitions, are their core underlying margins actually holding up? Or is that 58% maybe masking some underlying cost pressure from integration?
That's an excellent point. And yes, it is a blended number. Management was actually pretty clear on the call. Their core margins are, in fact, expanding.
Okay.
However, that expansion is being offset temporarily by two main factors. First, like you said, integrating newly acquired partner managers. They often carry slightly lower margins initially until they're fully plugged into the Brookfield platform.
Makes sense. And the second factor?
The second factor relates specifically to Oaktree. You can think of Oaktree's current phase like a massive construction project, maybe. They just finished building a huge tower, right? And return those profits to capital back to their clients. That phase of returning capital temporarily lowers the fee base.
Oh.
We haven't quite broken ground yet on the next massive fund and started calling down the new capital for deployment. So there's a temporary dip. But the key takeaway is that management is really optimizing for continuous absolute FRE dollar growth, not necessarily managing to an exact margin percentage target each quarter.
Right. Focus on the dollars, not just the percentage. That operational efficiency is clearly key. But speaking of massive scale, all these efficiency gains seem really designed to fuel their equally massive strategic pivot towards these big secular growth areas.
Absolutely.
Let's start with the immediate big news on that front. Oaktree.
Right. So they confirmed the agreement to acquire the remaining 26% stake in Oaktree. They expect that to close sometime in the first quarter of 2026.
Yep.
And this isn't just about, tidying up the ownership structure. It's really about creating one fully integrated, leading global credit platform. They were explicit. This consolidation is designed to accelerate collaboration across lending origination and distribution, and critically, feeding their growing wealth channel with Oaktree products.
And the mechanics of how they're paying for it seemed pretty smart, too.
Very much so.
The $1.66 billion acquisition price for that remaining stake, they said it'll largely be funded by monetizing specific securities and investment positions that are already on the Oaktree balance sheet.
Exactly. They're essentially using Oaktree's own assets to help buy the rest of Oaktree.
Which, as management stressed, makes the transaction highly accretive almost immediately. Because you get that operating leverage and the back office synergies once the subsidiary balance sheet is fully integrated.
Precisely. So that's the sort of immediate term consolidation focus. But the long-term future they painted, it's pure power in data.
AI infrastructure.
Absolutely. Management is positioning the firm to really dominate the AI infrastructure build-out. They're launching a brand new dedicated AI infrastructure fund. They're targeting its first close before the end of this year.
Before year end, okay.
And they view this AI-driven demand for power and data centers as not just a short-term thing, but a decade-long infrastructure tailwind. They actually estimated that AI-related infrastructure investments globally could exceed, get this, $7 trillion over the next 10 years.
$7 trillion. That number is just, it's almost hard to get your head around. For context, that's roughly the GDP of, France and Germany combined?
Something like that, yeah. It's enormous.
Are they justifying that purely based on energy demands and data centers for AI?
Primarily, yes. The power needed, the cooling, the data storage, the networks. Yep. It all requires massive physical infrastructure.
Right.
And that scale, that $7 trillion idea, it dovetails perfectly with their existing energy transition platform.
Right.
This quarter also saw the final institutional close of their transition fund, too. That closed at $20 billion.
$20 billion.
Which officially makes it the largest private clean energy fund ever raised, globally.
And it's important to note their transition platform isn't just focused on wind and solar, is it?
Absolutely not. They specifically highlighted a landmark partnership they've struck with the U.S. government. It's to construct $80 billion worth of new nuclear power reactors using Westinghouse technology.
$80 billion in new nuclear.
Yeah. Management called this out specifically as one of the single most compelling growth opportunities in their entire transition platform. It positions them to potentially control electricity generation capacity at a massive, massive scale for decades.
Speaking of scale, 2026 is shaping up to be just an enormous fundraising year for them.
Looks like it.
They confirmed the launch of Infrastructure Fund 6 is coming in early 2026, and they're also launching Private Equity Fund 7. They anticipate that one will be the single largest private equity fund in the firm's entire history.
Huge flagships coming. And importantly, they're also expanding who they sell these massive products to.
Ah, the wealth channel.
Exactly. We saw significant growth reported again in their retail and private wealth channel. They recently launched a new private equity product that's structured specifically for individual investors.
Okay.
And management actually expects this new PE product for individuals to scale even faster than their already very successful private wealth infrastructure fund. That growth means they aren't solely reliant on, giant institutional pension fund checks anymore. They're diversifying their client base significantly.
Right, tapping into that huge pool of private wealth. Okay, let's shift gears slightly, look at the competitive landscape. What broader themes are really defining success in the alternative sector right now, especially thinking about their big moves in credit?
Well, the entire alternative sector is really benefiting from two major secular shifts. First, LP capital, institutional money is moving heavily toward real assets and credit, away from traditional stocks and bonds to some extent.
Okay.
And second, the market is still trying to digest and fund the infrastructure demand shock driven by AI and the energy transition.
Right.
And crucially, fundraising itself is bifurcating. The market is heavily favoring the mega managers like BAM, who have these massive scaled platforms that can actually absorb and deploy billions, even tens of billions, efficiently. The smaller players are finding it tougher.
Okay, so scale matters more than ever. Now, let's drill down on private credit specifically. Given that they're consolidating Oaktree, a credit giant, how are they viewing well, let's face it, the very crowded middle market direct lending space? Are they jumping in?
They were actually highly disciplined in their commentary on this. They stated quite clearly they are actively avoiding the most commoditized segments, specifically mentioning middle market direct lending.
Avoiding it. Why?
Because they see compressed spreads, meaning lower returns for the risk, and they're seeing covenant degradation appearing, weaker protections for lenders. So their focus remains purely where they believe they retain a competitive edge. Things like real asset opportunistic credit, lending against hard assets, and asset-backed finance, areas where they can leverage their deep operating expertise across Brookfield's other businesses to achieve better risk-adjusted returns than just plain vanilla lending.
So playing to their strengths in complex, asset-heavy situations makes sense. Okay, so if we're tracking this aggressive growth outlook, what are maybe the three key near-term catalysts that investors or anyone watching should really keep an eye on?
Yeah, I'd say track 3 milestones over the next, say, 6 to 9 months. First, definitely that first close of the inaugural AI infrastructure fund, set by the end of this year. That's a big signal.
Okay, AI fund close.
Second, watch the closing milestones for the full Oaktree acquisition. That's targeted for Q1 2026. Any hitches there would be notable, but completion unlocks those synergies we talked about.
Right, Oaktree closing.
And third, just keep an eye on the fundraising progress for those mammoth flagships. PE1E and Infrastructure 6 launching next year. How quickly do those raise capital? These events will really validate whether their fee-bearing capital can accelerate significantly beyond that current $581 billion base.
Got it. And just tying back to the big picture, management did lay out a pretty explicit plan, didn't they? Doubling the business by 2030.
They did. They put specific targets out there, aiming for $5.8 billion in FRE, $5.9 billion in DE, and $1.2 trillion in FBC by 2030.
$1 trillion plus in fee-bearing capital.
Yeah. And they also mentioned, almost as an aside, that they're positioning the firm for the eventual, massive opening of the U.S. 401k market to private assets. And that potential upside, it isn't even including their baseline 2030 target. So that's potential gravy on top.
Okay. We have thoroughly covered the operational strength, the pretty aggressive strategic pivots, and the long-term guidance, which means it's now time for our segment. This is not financial advice.
All right. So given the somewhat flat market reaction to what were, frankly, massive, potentially generational announcements, that $7 trillion AI thesis, the $80 billion nuclear partnership.
Yeah, the stock didn't exactly pop.
No. So we believe the optionality embedded in the stock, related specifically to these very long-dated themes, might currently be cheap. The market often struggles, to properly price growth that's maybe 4 or 5 years out, or even longer.
Okay, so perceived mispricing of long-term optionality. What's the trade idea?
Therefore, the outrageous but plausible trade idea we're pitching this time is a calendar call spread on BAM.
A calendar spread. Okay, break that down.
Specifically, we're thinking about buying 1-year calls, fairly deep in the money, and simultaneously selling or writing out of the money 3-year calls against them.
Okay, buying near term, selling longer term. What the spread structure? Why not just buy calls?
The reason for the spread really comes down to timing and volatility expectations. We're essentially betting that a specific near-term announcement, maybe the first close of that AI fund, goes really well, or perhaps they announce a truly massive multi-billion-dollar AI-related transaction.
Something that validates the thesis quickly.
Exactly. We think something like that could spike short-term volatility and the share price significantly in the next, say, 12 to 18 months. The calendar spread structure allows us to potentially profit more from that short-dated call pop, funded partly by selling the longer-dated call, which likely reflects lower implied volatility tied to more conservative, smoothed-out long-term growth estimates.
So you capture the near-term excitement before the longer-term view perhaps dampens it.
Kind of. We're betting the immediate market reaction to a major validation point, a big AI deal, a faster ramp on nuclear will be nonlinear, that it could drive FBC and FRE significantly higher, faster than the current consensus implies, benefiting that shorter dated call disproportionately.
Interesting. A structured bet on an immediate spike from an unfolding infrastructure supercycle narrative. All right, to quickly summarize this deep dive then, Brookfield Asset Management delivered record capital formation this quarter, $30 billion raised. Alongside that, a very clear strategic shift towards fully integrating Oaktree and aggressively positioning itself to dominate what they see as the AI and energy transition megatrends of the next decade.
Yeah, and maybe the final thought for you, the listener, is this. Considering the company's explicit stated goal to essentially double the entire business by 2030, does that slight top-line revenue miss this quarter truly outweigh the potential compounding effect of the $30 billion in new capital they just successfully raised and have time for deployment into these huge themes? Something to think about.
Indeed. And please remember, this deep dive is purely for informational and conceptual discussion purposes. It is absolutely not investment advice. Thank you for joining us on Talk Tickers.